Hi, LJ Aguinaga here with LJ Realties, and in this segment I'm going to talk about real estate taxes. When do they apply, how do they affect us, and what do we have to keep in mind? So the first thing we have to think about when buying a new construction property is sales tax. Very similar to when we go to a store and buy a piece of gum, you're going to have GST and PST added to the sales transaction. So that's a total of 14.975% that gets added to the purchase price. If you are within certain price points, there are some reimbursements given by the government, but that is the exact same sales tax we're going to have. After that, if you purchase the property with less than 20% down, you're going to have an insured mortgage. And on that insurance premium that you're paying, there's going to be a 9% tax that you're going to be charged in order to go down that road. The next tax you have with the acquisition of the property is welcome tax or land transfer tax. And the way that one works is that it's a percentage of the sale price or the municipal valuation. In the current market situation that we're living, it's generally speaking the sale price because that's higher than the other one. And that is basically a sliding scale. As the prices go up, you're going to be paying more tax on the property, okay? Now that covers taxes from acquiring the property. After that, once you're the owner of the property, you're going to have two recurring taxes every year that we're going to pay to the municipality and to the school board. Those are called municipal taxes and school taxes, okay? Those will be paid every year, and generally speaking, you pay them twice a year. So they're broken down, the bill gets cut in half and you split it up that way, okay? Now, if you have an investment property or if you are having revenue come in from the property, you're also going to be exposed to income tax, okay? You're going to have to declare that income every single year. You're going to have some deductions. You're going to be able to write off the taxes, the interest that you're paying on the property, any improvements that you made, stuff of that nature. And after that, you're going to have a percentage of your income that's going to be taxed based on the revenue that you receive from the property, okay? After that, if we really want to break it down, if you sell an investment property, a property that you have not been living in, you're going to be exposed to capital gains tax. And the way that works is the government's going to say, okay, what did you sell the property for? What was your acquisition cost or your new adjusted cost base? And that's calculated based on how much did you pay for the property, plus any capital improvements that you did to the property, as well as any other acquisition costs that you had on the property. They're going to ask you to subtract one from the other. And on that amount, 50% of it is currently eligible to be added to your tax bracket, okay? So if you are in the highest bracket, we usually say that, okay, whatever your profits were, you're gonna pay about 25% tax because you're taxed at about 53% and you're only exposed to 50% of the gain. So roughly it's 25, 26%. That's why we do a quick calculation, okay? If you have any further questions, please reach out to your accountant. I'm not an accountant. I have a lot of experience and can give you information based on my experiences, but you should always speak to your accounting professional to ensure what kind of taxes you will be exposed to in the purchase of your property. Thank you so much for watching. See you next week.